Do you really need 20% down to buy a home? Does getting pre-approved hurt your credit? Do you not think you make enough, or you don't think your credit's good enough to buy a home right now? There are so many questions and myths out there that keep people from wanting to attempt to buy a home. Today, I'm bringing in Giancarlo from AFM Lending, and he's gonna break it down from start to finish, the home buying process. We're gonna talk about a whole lot today. We're gonna talk about pre-qualification versus pre-approval. We're gonna talk about loan programs, down payment assistance, first-time home buyer programs, and some of the biggest mistakes that you don't wanna make once you start the home buying process. If you're thinking about buying a home now or within a year, you definitely wanna watch this video. It's gonna give you a whole lot of information that you're gonna wish you had when you get ready to buy. My name is Yolanda Street. I'm part of the Living in Phoenix team. I get calls, texts, emails every day from people just like you that's wanting to relocate here to Arizona and buy a home. If you're thinking about relocating here in the next 12 months, 12 weeks, 12 days, or even 1 day, definitely reach out to me so we can get you started in this process. Giancarlo, you want to go ahead and introduce yourself?
Of course. So my name is Giancarlo Andere, and I am with AFM Lending. We are powered with PMR. But we've had the pleasure of being in the mortgage industry and lending for over a decade now, and we've had a very beautiful natural evolvement of what do we do and how we do it. And we have a strategy first focus. Essentially what we do is we try to figure out what is going to be the best financial position for you to be in, so you can essentially purchase and get into real estate. And because of that, one of the big common questions that I get is, what type of loan programs do you offer? It's a whole bunch of stuff, but let me give you a couple of examples. We'll go down FHA down to 500 credit score. We will do manual underwrites and down payment assistance programs. Conventional, we don't have a minimum credit score for that. We do non-QMs, for you business owners out there, we don't need tax returns. We do I-10 loans, foreign nationals. We do all types of visas. So if you have DACA, or you just got your work permit for you to start, working here in the United States, we have those programs available. We have things like home equity lines of credit. We have construction loans, ground up construction, commercial, residential. We have fix and flip loans, hard money deals. So we have a very, very advanced amount of stuff, including reverse mortgages as well, for those that are actually in that stage in life. So yeah, we do make sure that your strategy is first.
All right. So you guys got a lot of information you're going to take in this video. Definitely stand by. Let's go ahead and jump right in. So okay. Giancarlo, how long does a pre-approval actually take?
So the pre-approval doesn't really take a long time. I mean, from the moment that we get the documents, it can be 24 hours, okay? Now, a lot of times it can actually be a little bit sooner. However, most of the time it actually takes a little bit longer, because in order for us to give you something that is really worth your time, well, we need to get all the documentation. And I know the documentation can sometimes stress people out, right?
Yes.
So if you have, for example, just a traditional job, you're gonna have a paycheck and W-2s and tax returns, you're good there. If you're self-employed, it depends on the type of business you have. So if you have an S Corp, a C Corp, if you have multiple rentals or partnerships, and you have 1065s and et cetera, right? We're gonna have to gather all that information, including P&Ls and balance sheets, which can kind of extend the time of purchase. However, it all depends. If we have all the documentation up front, usually under 24 hours, you'll have a pre-qualification.
Okay. So another thing that a lot of buyers ask me about is, does the pre-approval actually hurt their credit?
No, pre-approval doesn't actually hurt your credit. Okay, what hurts your credit is when you're shopping around and everybody's doing a hard inquiry. That's what you gotta watch out for.
Okay.
Normally, 3 pulls within a 45-day period of time. You gotta remember, this is a lot of money. You're asking for $300,000, $400,000, $500,000 to borrow in order for you to purchase a property.
Okay.
Well, they're gonna give you a little bit of leeway. However, with us, we started always with a soft pull where it doesn't actually hurt your credit. And then if we decide to move forward, right, or you find a property, then we can do a hard inquiry. And guess what? We can actually do a full pre-approval with a soft pull.
So you don't do the hard pull until toward the end?
Unless we actually need it out towards the end, absolutely.
All right, that's cool. Good to know. A lot of people are concerned about that credit.
Mm-hmm.
So I'm gonna ask you a few things. I'm gonna throw some stuff at you. I want you to tell me fact, myth, or somewhere in between.
Okay.
These are true questions I get from clients, so just be prepared.
All right, let's go.
You just said getting pre-approved will hurt my credit.
That is a myth.
Okay, unless you do a million pulls.
Unless you do a million pulls, right?
All right. I don't need to talk to a lender until I'm actually ready to buy the house.
That is a myth, okay? So I know that a lot of you guys might actually handle your finances pretty well. However, you don't know mortgage guidelines, okay? And mortgage guidelines might not fit the same thing that you're looking at. So no, that's totally a myth. You need to absolutely talk to a lender.
Okay. Next question is, just because I'm pre-approved now, am I obligated to buy the house, or can I change my mind?
No, absolutely not. That is also total myth, okay? You can get pre-approved and take, 6-9 months, a year to get, to execute that purchase. However, is where I put a little asterisk over there on this, is that if your financial situation changes, look, if you go buy furniture and you get into debt, if you go buy a car, if you change jobs, if you start getting less overtime, more overtime, or if your income changes from I have a W-2 40 hours to commission, yes, those applications and those things change your application totally. However, if you get pre-approved first and nothing changes, then we can absolutely continue with the pre-approval that way.
Okay, and real quick, how long is a pre-approval good for?
Normally it's 3 to 4 months is what you're actually looking at as a span from the moment that you get pre-approved, where we more than likely won't need to get updated documents, some of them. Paychecks, they can be 60 days. Okay, so it just depends on the type of document. Yeah.
Okay, so now that we've done that, I really want to spend a few minutes talking about the down payment assistance program. Just because a lot of people hear down payment assistance and they automatically assume it's free money. And I definitely want to have you tell us the big picture of the down payment assistance program and how using that program versus bringing my own money can be different.
Oof, okay. So this is kind of a loaded question and we can go into just a whole hour talking about this, right? And not even scratch the surface. But let me try to condense it into this.
Okay.
There's going to be 3 different types of down payment assistance programs that you're going to be looking at, most common. The first one, it's a grant. You normally come into the down payment assistance and they say, we're going to give you this. There is no repayment necessary unless you refinance or sell the property within a certain period of time. So let's say 7 years. So that is beautiful because that loan you're not repaying. The next one is we have a repayable down payment assistance. Okay, so a lot more flexible than the first. Essentially, they let you borrow the money and they put an interest rate onto the second, onto it, and then you're making a payment on it, and that's what essentially happens. Now, the third one is actually really, well, sometimes uncommon, right? Which is a silent second. We have had this certain circumstances, right? They're phenomenal. They usually give you a lot more money, but essentially what happens is this. They'll say, here you go. We'll give you 4 or 5% of the purchase price for you to purchase your property. However, it's going to stay on the loan for 30 years. And there's some programs, that we've had that actually do that. And those are generally the 3 most common ones. There is the grant, a non-repayable silent second, and then there's also a repayable second. So there's going to be some interesting facts with that. And there's other variations too that I kind of threw in there too as well, but that's why you always consult with the lender first.
Okay, so with a down payment assistance program, it's fair to say that it may be great for some buyers, but it's not safe to assume that it's good for you just because you think the money's free or because it's available.
No, the money's never free, okay? There's always going to be some type of caveat with it, especially if rates go down and you have a grant. Well, are you going to be the type of person that says, no, I'm going to stop, doing this, until I actually get the income? Or are you going to be the type of person that says, I'm going to jump in so I can get the interest rate that I want? And, it just depends.
Okay. So a lot of people also ask me about other programs out there. Are there really programs for first-time home buyers, teachers, first responders, healthcare, veterans?
Yes, there absolutely are. Okay, so there's some down payment assistance programs that give you a little bit extra for depending on the type of service that you do, right? So they're phenomenal. So for example, we have one that will give anybody that qualifies for it 3%. But then if you're a teacher, a first responder, then you get 1% more, right? Or 1.5% more. It really depends on the type of program.
Okay. And then a lot of people ask, first-time home buyer, does that mean somebody who's never owned a home?
No, that's also a myth, okay?
Okay.
So here's the myth. And here's the reality. A first-time home buyer is somebody who hasn't purchased a property in the last 3 years. Our mortgage guidelines change so rapidly that not everybody that purchased a property, let's say in early 2000s, is going to qualify for properties right now in 2026.
Okay. And it sounds like we have to remember that these programs change all the time. So we need to talk to you, or somebody needs to talk to you.
Absolutely.
To find out what programs are still current and which programs are not.
Absolutely. And then we start off with the strategy, right? That's the kind of important part for us.
Okay, and then as far as getting pre-qualified, what are the main documents that you ask for?
So that also depends on who you are, but I will segment it into this way. If you are not self-employed, which means that you're not a sole proprietor, you don't have an LLC, or you don't have a business, then we're gonna need W-2s last 2 years, all the business, all the works, all the employment that you've had, or all the places that you've worked in. We're gonna need tax returns for the last 2 years, copy of ID. If you're a non-permanent resident, or if you have a green card, we're gonna need a copy of that, if you have that, right, including DACA recipients. If you are self-employed, okay, then we're gonna need now your business tax returns, right? Whether you have a 1065, an 1120S, or an 1120, we're gonna need that in addition to your personal tax returns. And then obviously the assets, right, from all the accounts that you have. And why all the accounts? Because I get this question all the time. Why do I need to give you all my stuff? I'm like, look, it's not that I particularly care, is that I particularly care about you. And here's why. I want to make sure that when I'm giving this loan over to an underwriter, they're looking at your full financial picture. And if they see that you have a good history, or you have the ability of saving some money, right, and not end up in total zeros, then it's going to be a lot more likely, a lot stronger of an application for you, right? And a lot easier for you to go out there and negotiate as well. So look, the benefit is yours. It really, what we're trying to do is just guide and strategize for you to get the investment, okay? And you need the money to get that investment, and that's just what we do.
Okay, and for income, does all money count? Like retirement, child support, maybe adoption subsidy, commissions, overtime. Can we count all that?
That all can be counted, okay? But it also depends on your situation and how long you've had it. You know how unfair it would be if you, let's say, want to go buy a house, you go get a second job, right? And you're working 40 hours at one place, and then you're working 30 hours on the next, okay? But you are killing yourself, right? You're really just exhausted. How long can you keep that up for? Okay, it would be really setting you up for failure if we were to use both incomes at the same time. Now, that's just kind of a brief example, but that's essentially how income works, right? So when we're looking at it, there are thousands upon thousands of different income calculations. We need to explore a lot of times these, if they're not just a standard, 40-hour standard employment, we have to go and dig into it. But yes, you can use, you can use things like Section 8, believe it or not.
Really?
Yeah, yep. You can use Section 8 income.
Okay.
Very, very unique situation, right? But that's one of those things, that people ask, like, can I not? Yeah. You can use adoption subsidies. You can use, foster care income, right? You can use ADU. So if you rent a little apartment, or if you house hack, there is a possibility for you to do that. There's things like broader income, which is essentially what I described, where you house hack and you rent a couple of rooms in your house, right? You can do that. Social Security, retirement, you can use dividend income. And we have something really cool called asset depletion. So for those of you that love to save, okay, and you say, hey, you know what? I don't want to deplete all of this stuff, but we don't make enough to qualify, in comes asset depletion.
Okay.
Here's how it works. You have a large amount of money in the bank. You don't want to pull it out. We can actually use it as income.
Okay.
All right. So all we're doing is just taking the full amount and we're dividing it over a certain amount of months. And that's what we use to add as income in order for us to qualify you. That's a little trick, and strategic
cool,
that we do.
though.
That is cool. So financial planners, come on. If you're a financial planner, if you know your financial planner, I think they're going to love this because your money is still at play, but you can still go out and purchase a property. So.
All right. Sounds good. Now moving along. So Giancarlo, somebody who's never purchased a home before and they're nervous.
Okay.
What exactly is a lender's role in the home buying process?
So the lender's role is truly to become a liaison between somebody trying to purchase a property and acquiring the money that they need to do so. So our job is to guide you through that process. That really is what it is. I don't know if that's what you were expecting,
Yes.
but that's what we are.
It works. Many people think the realtor finds a house, they think the lender gives the money out, but there's a whole lot happening behind the scenes, more than that, from beginning to end.
Absolutely.
Let's start with something that I hear all the time.
Uh-huh.
Getting pre-qualified and getting pre-approved. Is that really the same thing?
No, it's not the same thing. And honestly, so there's 3 stages of this, okay? So we'll have essentially a verbal confirmation or verbal pre-qualification, right? And there's a lot of online lenders out there that will give you the best rate. You just tell them, this is what I make and this is what my credit score is, and they'll give you a pre-qualification and you go out and shop. No verifications whatsoever. That's usually just a, verbal pre-qualification. Most lenders will do a pre-qualification. Essentially what it is that they'll take some of your documents and they may or may not run something that we call AUS, which is an automated underwriting system. And what it does is it kind of packages your whole entire situation. So we need to run credit, verify income, and then we run this and it gives us an initial approval. Okay, that's a pre-qualification. So if you're shopping with that, you're doing good, okay? However, a pre-approval. So a pre-approval is after you go through all those stages, an underwriter, the person who's actually going to make the decision on your loan, actually does a review. So they'll go through all of the credit scenarios and credit settings that you have. They'll go through all the income, because income changes a lot through the underwriting process, by the way, and they'll review the whole situation altogether. So obviously when you're going out there and shopping, a pre-approval, it's going to be a lot more of a negotiation strategy than it is just for you to get a pre-qualification. And you have to be careful of those pre-qualifications too, where lenders actually don't even run AUS. They just go based on, oh, he has a great credit score and that's it. Unfortunately, that doesn't work that way.
I have to honestly say, I've had a few clients come here to Arizona. They already have their lender, and they did that pre-qualification process where they didn't pull any documents. They get here to Arizona, and they cannot get them qualified. And I've had to call you
absolutely
to clean it up.
Yeah, absolutely. And then we have to go and re-strategize, put all these things together. We have to add a bunch of stress, because honestly, imagine that, uprooting your whole entire family, going to a completely different place, and now being here. That's got to be rough.
Yes, yes. So let me ask you, what do you need from somebody to get them pre-qualified?
Okay, so basic items is this, a full application. Okay, that's going to be the very first thing. It's going to give us all your information, okay, where you've worked the last 2 years, where you've lived the last 2 years. We're going to get all of your personal information, right, as far as, name, social security, email address, all those good stuff right there, so we can start the process. Now, documentation. What documentation we need? This is going to be a little bit different depending on who you are and what type of finances you do.
So you guys have a lot of information so far. We're going to finish this out, but you're going to have a lot more to go. Really appreciate Giancarlo being here helping us out with this lending stuff, because usually I call you when people ask me questions that I don't know. I always say that's a lender question.
Absolutely.
Let's get you on the phone. So let's say somebody calls you, they want to buy a house, but after you look at all their documents, you see they're not quite ready.
Ooh,
what happens next?
Oh my gosh, this is, first off, I think it's really disheartening, right? When somebody goes into the application and they're like, oh, they haven't gone back to me, I get no direction, and look, granted, sometimes, as lenders, we get a little bit overwhelmed, right? with the amount of, things that we have to do research on to help you guys qualify. But here's a cool thing about it, right? What we are trying to do is give you essentially a path forward, okay? Understanding with what you're gonna do next, whether it's working on credit, whether it's sometimes, getting a little bit more income, or putting a plan together essentially for you to be able to purchase a property. But that's what happens, right? We don't wanna see you just go and just not know what to do next. We wanna be able to guide you through this process.
Meaning you can give them some ideas on how to increase their income, or what bills to pay down, or even things to up their credit score?
Absolutely. So on the income part, it can be a little bit dicey, right? Because obviously those are careers, so depending on what you like doing and how you like doing it, it's going to be a little bit difficult. However, what we can do is give you a target goal or a target income goal. And then obviously we can work and help you guys through credit and say, if you pay this down, or if you get that card, or if you get this loan, or you remove that, or et cetera, right? That's where we can come in and help you with it.
Okay. So ideally, I wanted to bring this up because I don't want people to be scared to call a lender because they're scared to hear the word no. I like to tell people it's not necessarily no, it's just not yet in my book.
Correct. And honestly, it's part of the process too, right? I mean, you're not always ready. Okay, we want to be, but having this expectation of you going in there and essentially getting qualified right away, well, sometimes you can, and if you manage your finances, it's a whole lot easier, okay? But if you don't, I don't want you to be scared about it, right? I want you to think about it this way. Imagine going to the casino and expecting for you to win the jackpot every single time. It doesn't work that way, right? And by the way, not that we're gambling here, but it's kind of like the same concept, right? Look, you're gonna try, we're gonna put a path together, and we're gonna help you build that resilience and that structure for you to be able to purchase your property.
All right. So when you try to determine what somebody can qualify for? You're looking at credit, income. Is there something else I'm missing?
Credit, income, and actually, two things.
Debt to ratio.
The amount of money that you're going to look at putting in the initial investment, so your down payment, okay? And then the last one that many people just kind of completely forget about is the consistency of employment.
Okay.
Extremely important, right?
Okay.
If I'm self-employed and I just started a business, I don't have enough history. If I went from, getting a W-2 job into this great sales gig, where I'm going to pay a lot of commission, I don't have a lot of consistency on that, especially at a short period of time. So at 1 year at minimum is what we need in order for you to be able to qualify for either one of these incomes. Yes, including being self-employed.
So going from W-2 to self-employment is at least 1 year.
It's at least 1 year.
Okay.
Correct.
Does that mean you have to stay on, if you're W-2, do you have to stay on the same job for for 2 years or 4 years?
Not necessarily, okay? So this is a very big myth as well.
Yes.
I get a lot of people that say, hey, well, I haven't been at my current job for 2 years. I won't be able to qualify for a house. No, that's not how it works, okay? We look at the consistency that you've had in earning income, but what happens if you get offered a better position, right? Let's say that, we're starting out as working as a server, right? And then all of a sudden you get offered this position to go into an office and you go from tips, tip income, and a little bit of base, to now more consistency, at $25, $26, $30 an hour. Well, that's going to only help you, not going to disqualify you.
Okay.
So it's only when you're going the reverse, right? So let's say that you're getting $25, $30 an hour, and then all of a sudden you go back into, for example, car sales, like you go into car sales, where yes, you can potentially get a lot more money, but it's also inconsistent. So we have to look at these things, in that fashion.
Okay. So technically a person can qualify for more than what they want to afford every month.
Yes.
With that being said, would you recommend a buyer base their decision on what you qualify them for or what they want? Because I have a lot of people who are renting and then they decide they want to buy and they think they can keep their same mortgage amount as the amount they were paying for rent. And sometimes it jumps up and they're scared. So what would you tell a buyer that's kind of in that situation where you can qualify them for more, but they haven't been paying that?
So I'm going to be a little bit blunt on this, okay? So I don't mean to hurt your feelings, but you can't be unrealistic here, okay? If you are paying a certain amount of money in rent, you're not ever going to have that same amount of money, on a property that you purchase. And here's why. We forget about the other things that come implied into it. As an investor, I have to go put 20% down on a property to purchase it. As a first-time home buyer, you're putting 3 or 3.5% down on that same property. Well, my mortgage payments are going to be totally different. The tenant, the renter, or the investor, right, the landlord can rent you out the property for a certain amount that will cover his mortgage payment. When you're going and purchasing your own property, if you put 20% down, then you can do a comparison. But you're not going to be looking at trying to get the same mortgage payment on both of these because first off, a lot of you guys are renting an apartment. How is it that we're making the comparison of, hey, I'm renting an apartment for $2,000 a month. I'm gonna go buy a 3-bedroom home, that's 1,700 square feet, with its own garage and have all of these other things, a backyard for the same amount. It doesn't add up. You're not comparing apples to apples. So no, it doesn't work that way. You can't compare one with the other. You can, however, make an assessment of where you're currently at and be ready that your mortgage payment is going to naturally be higher, but it's your own investment. And throughout time, that becomes easier and better.
Okay, so what are the pros and cons of, I know we don't need 20%, but what are the pros and cons of putting more money versus less money down on a home?
Well, the more money that you put, it becomes a little bit of a safer investment, or a little bit easier for a lender to actually let you borrow money, right?
Okay.
Well, it's just simple math, right? If you're borrowing less money to buy an asset that has more value, then the lender's more likely to let you borrow the money in order for you to, purchase that asset, right? Okay. So there is a big advantage of you being able to put that kind of money down. Now, obviously, it all depends on your capabilities. And I think that that's where the myth for the 20% down really came from, is because originally you did need a pretty large amount of money in order for you to purchase a property. And then first-time home buyer programs came about. And I think we talked about it a little bit, right?
Yeah.
But that's how it works.
Okay. So real quick, if it's your second home or investment home, is that where the 20% comes into play? Because I hear that too.
Yes, actually, that is really where it comes down to. If you're going to purchase an investment property, minimum percent down is 15. Okay? You don't have to put 20% down. However, highly recommended, because that's when you avoid mortgage insurance on a conventional loan.
Okay.
On an FHA, you put 15 or 20% down, well, you're still paying mortgage insurance. Those loans are not really designed to do that. Same thing with USDA. Well, if you're a veteran, there is no mortgage insurance. Okay, there's something that's called a funding fee. And that essentially gets added onto the loan or paid off completely depending on your situation.
Okay, so talking about mortgage insurance, where does that actually come into play?
Okay, so mortgage insurance really is a protection to the lender or the entity that's letting you borrow the money. It really goes like this. If you can't make the payments on the property, well, they have to come back and take it back. Okay, it's kind of like repoing a car. Well, if you are getting a car repoed, well, you got to pay the tow truck guy and you got to pay them, for storage fees. And depending on how many times they have to go back, they have to go, figure it out. And then when they get the car back, they're gonna see if there's anything that needs to be repaired on the vehicle, right? Well, mortgage insurance serves just like that. It pays that expense specifically for the lender. So if they need to come and take the property back, well, there's court fees associated with foreclosures and short sales. They have to staff it, staff and the people, right, in order for them to be able to manage through these type of transactions. If they need to repair the property, if the property is not worth enough, okay, because we've had a little bit of a downturn, then when it gets sold, it's going to be extremely important for them to cash in on that PMI.
All right, cool. Mortgage insurance. Let's talk about something that's very important. I probably want to talk about this more than anything. And a buyer's pre-qualified, they're shopping, they're under contract. What should they not do from the time of getting pre-approved to getting the keys in their hands?
Okay, so there's a few things that you don't want to do. Okay, first off, don't go walk into a dealership. Don't go buy a car. Okay. If you might need a car, this is going to be a little bit difficult because that's on a situational basis, okay? But very few of you guys are actually going to be purchasing a property and actually having to buy a car. Don't buy a car, okay? Don't go and apply for credit cards. I don't care how great that 20% off of that 99-cent item you're purchasing off, like it doesn't make any sense. Do not go and apply for new credit cards. There's no reason to. So don't go and start moving money around. Okay, that's also a really big thing. Okay, don't move money around, from one place to the other without consulting with your lender. Don't change jobs. Okay, also something you want to make sure and consult with your lender about, because your income is going to be, a pretty big important piece of this, right? Because that's essentially what we're trying to make sure we can validate and find consistency in. So those, I think, would be the most important things. And there's a couple of other things that you don't want to do, but essentially they all kind of boil down to those things.
So anything that you want to do, really the best thing is to do is talk to the lender, make sure it's okay, and you'll never get upset from a client calling you to ask you about something.
No, that's what we're here for, right? We're here to put the strategy in order for you to purchase a larger asset. Now, notice, that I'm not saying for you to buy a house. We're actually purchasing an asset. This actually creates value and adds onto your net worth. This is why it's so strategic for you to purchase real estate.
Okay, so I have to ask you, as a lender, will you do a check on everything about my buyer prior to closing, even though they already got clear to close?
Yes, absolutely. So we will do another soft pull, just make sure that you haven't applied for anything else. Look, we're gonna find out, okay? I've had people that come in and purchase they purchase a vehicle and then they go in and get into pre-qualification and they don't tell me that they just bought a vehicle. Then all of a sudden we'll get under contract, okay? And then now we have to do credit updates and now this debt appears on there. And the first thing that they say is, well, the car salesperson told me that it's not going to appear on there, so it's not gonna be a problem. Well, first off, they're not mortgage people, okay? They don't know mortgage guidelines, and yes, we are going to find out. So it's gonna be extremely important. We're going to run those checks every single time, okay? Make sure that you have no lawsuits or anything that appear under your name, okay? That's gonna be really important for us.
And a lot of clients get confused between conditional approval and clear to close. And they get a little scared when they get a conditional approval. Can you talk about that?
Okay, so when you're looking at a conditional approval, it just means that an underwriter reviewed the file and said, based on these conditions is what we're going to need to clarify for you to get a clear to close. However, there are so many different things that happen on a conditional approval because an underwriter cannot give you a full approval on a loan if we do not have the house, if we don't have clear title, if we haven't made sure that the property is valued there. So it allows us to figure out that when you get under contract, then we are going to have to check all these things, but we already know what you're going to need, right? So if it's a clarification on one of your employments or a verification or making sure that you have this consistent amount of hours, right? Those things we're already gonna know, and that's what a conditional approval is. Now, after you find the house and you figure out your title, your property, the value, insurance, etc., then you get a clear to close. It means that all of those items were reviewed and you're ready to go.
I know that's a good thing. When you call and say so-and-so's clear to close, that just,
Absolutely.
that's great.
Hey,
So-
congratulations, you're clear to close.
So everybody knows the big topic that you hear all the time is interest rates. So we can't talk to you today without talking about interest rates. I don't want to discuss what the actual interest rate is today because somebody may watch this video 6 months from now. But I do want to talk about interest rates, how it affects a person, what it actually means, and is the lower rate always the best rate?
Okay, lower rate doesn't mean always lower cost. Okay, sure, you might have a lower rate and your mortgage payment is a little bit lower. It could potentially be that, but it also could potentially mean that you just spent a lot of money in order for you to do that. And it might not be actually a reason for it, okay? Now, rates are pretty interesting. Every single lender out there has the same interest rates. And when somebody calls and says, hey, what's your interest rate? Well, it's kind of a confusing question, okay? Because in order for us to be able to give an interest rate, we need to understand first the type of property that you're buying, how much money you're putting down, the type of loan, how many borrowers, what their credit scores are, what the debt to income ratio is, where location, so where is this property out, right? Because it's going to be different in approvals, and what is the current condition of the property? Okay, those things are going to matter because potentially you can be looking at a renovation loan versus not. So that's going to be really important. Now, I'm not trying to complicate the question. I'm just trying to bring light to what actually means when you're calling a lender and saying, hey, what's your interest rate? I need to know the type of loan. I need to know the structure first before I can adequately say, this is what you're going to get. Now, if there's other lenders out there doing that, kudos to them. I just don't work like that. I want to make sure that somebody has the right structure in order for them to be able to adequately measure against one another.
So you guys out there that are calling me saying, I want to buy a house, but I'm waiting for the interest rate to drop. Not really a good reason because as he just told you, it's based on so much more than just the actual interest rate of today.
Yeah, and honestly, here's the truth, okay? I have never, ever heard anybody say, oh my gosh, rates are too low.
Yeah.
Nobody, okay? So the idea is that you're always going to be stressed. You're always going to have a little bit of fear. There's always going to be a little bit of doubt that you're going to go into something like this. So I just don't want you to be disheartened by it. You need to start thinking about what is the best plan or what is the best entry point for me to get into investing into real estate. And how do we do that? That is the better question, not I'm going to buy until rates go down. Because when rates go down,
everybody's going to be buying.
And then if you don't have the money,
you're not going to get the
you're
loan.
not buying.
I always say fall in love with the house, not the interest rate, because you can always refinance.
You're always going to refinance, okay? There's always going to be at some point something. And this is where the strategy comes in place because depending on where you are in life, okay, you might be looking at trying to get the lowest interest rate. And then later in life, you might just be saying, you know what, let me get into a reverse mortgage, so I can clear all this out of my side. Okay, I don't want any more mortgage payments, and I'm just going to live here comfortably. There's a lot of reasons as to why we would do that too, by the way.
All right, Giancarlo. So another interest rate thing. I work with buyers that are looking for new constructions, and builders sometimes will offer attractive interest rates, different incentives that look really, really good. What is it and how is it that they can provide such low interest rates compared to a lender that's not working with a new construction builder?
Well, there's a very simple reason why. There is something called a builder forward lending commitment. Essentially what they're doing is they're prepaying interest rate. It's not that they have access to different interest rates. All they're doing is just saying, hey, a certain portion of this property that I'm selling, I'm going to be prepaying the interest for these clients, and we're going to offer them a lower interest rate. That's all they're doing. Okay, so the same interest rates that we all have, for the exception that they're paying all of those points upfront in order for you to get into the property.
So can a buyer come to you and want a new construction home and want to work with you and you offer those low interest rates?
We could potentially do that, okay? However, the amount of concessions that would need to be given or the amount of points that somebody needs to pay to get to that, I think that's the biggest question. Because some of these builders are paying upwards of almost 10% of the purchase price towards concessions, right? You know, bringing down the rate and paying for, you know, commissions, etc., right? It's usually 10%. So on a $350,000 house, you're looking at $35,000 to be used towards a rate buy down, and that is going to be very interesting because people don't know that.
All right, so before we wrap this up, we're going to do a rapid fire round.
Oh.
We're going to start, but before we start, I definitely want to tell you guys that I know we gave a lot of information. Like, share this with somebody else that you want to bring with you to Arizona, or somebody that you may know may be interested in buying a home. Comment below how this video has helped you out. And definitely, if you haven't subscribed, subscribe below, hit the bell so you never miss out on another video. I bring videos every week to this Living in Phoenix channel that talk strictly about Arizona and relocating here to Arizona.
Fantastic.
All right, so are you ready?
Oh, let's do it.
All right. Can I buy a house if I have student loans?
Yes, you can.
Can I buy a house if I have credit card debt?
Yes, you can.
Can I buy a house after bankruptcy or foreclosure?
Yes, you can.
Can I buy a house if somebody's gifted me my down payment?
Absolutely.
Okay. Do I have to stay on the same job for 2 years?
No, you don't.
Can overtime and bonuses count in my purchase of my home?
They could count.
Can I buy another home even if I already own a home?
Do this all the time? Absolutely.
Okay. And can I buy a house if I'm currently renting and my lease isn't up yet?
Absolutely. You can still purchase a property.
And should I wait for interest rates to drop before I buy a home?
No, you should not. This is your opportunity to go out there and negotiate. Go get the best price that you can. It's kind of like, imagine if you would have bought Apple stock when they barely came out.
Yes.
Would you have said, oh my gosh, it's too expensive? Look at this.
So the last question I have for you, Giancarlo, somebody's watching this video right now and they're thinking, I'd love to buy a home, but I honestly just don't know if I'm ready. What would you tell them their first step should be?
So your first step is for you to call me, okay? Put an application in, let's look at where you're at, let's build a plan, and then let's see how to execute. Okay, there's nothing more stressful than you having a little bit of ambiguity, a little bit of doubt, whether you can or cannot do it, and you kind of live through that. I'm like, no, let's remove that. Don't worry about your credit. You're not gonna be dinged. We'll get you a full plan, and hopefully we get into a house.
And this is why I made the video today, because I wanted people to know that you don't have to know everything about the home buying process to get started. That's why you have a team. You have the lender who helps you understand the financial side, the programs out there and the numbers. And then you have me as your realtor that will help you understand the market, find the right home, the right community for you and your family. I negotiate on your behalf and we navigate with you all the way to closing. So you have us during the whole process and even afterwards.
Absolutely.
So again, if you guys are thinking about relocating to Arizona, my name is Yolanda Street, part of Living in Phoenix. This is Giancarlo.
I'm with AFM Lending, okay? And you can find me at www.afm.loans.
All right, and I can't wait to see you on the next video.
You know what, by the way, I want you guys to go ask ChatGPT about me.
Okay, do that.
See you guys soon.
See you on the next video.